All right, let's jump straight into this explainer. Today, we're unpacking the massive wall of financial data behind Merit Medical Systems, ticker symbol MMSI. We're going to look right past all the everyday market noise to see what the numbers are actually telling us. There is a lot of data flying around out there, but our goal today is to focus strictly on the metrics that actually matter, making it crystal clear what's really happening under the hood of this business. To make sense of the whole shebang, we're basically going to treat this like a detective story. Here is our agenda. We'll kick things off with Section 1, the current price snapshot. Then we'll move into assessing valuation ratios, check out tracking growth and returns, verify the margins and financial health, and finally reveal the fair value and margin. So starting with Section 1, the current price snapshot, let's see exactly how the market is pricing MMSI today. Because, well, this sets the stage for absolutely everything else that follows. As of our latest data poll, the stock closed at $61.36. Now, at that specific price point, the market is slapping a total market cap of $3.59 billion on this company. It's definitely a significant player, but the recent market action, it's telling a very specific story. And honestly, this perfectly captures the tension we're seeing right now. The stock has taken a pretty painful 30% hit year to date. But if you zoom out a bit, long-term holders are still sitting on a massive 222% gain over the last decade. It's your classic setup, right? Short-term pain versus long-term gain. Which brings us right into Section 2, assessing valuation ratios. The crucial thing we need to figure out is whether this recent 30% price drop means the stock is suddenly a bargain. To do that, we've got to look at historical multiples. And wow, what's really interesting here is the sheer scale of the discount. Just look across the board, from price to earnings down to price to sales, book value, and free cash flow. Literally, every single current multiple is trading drastically lower than its 5-year average. I mean, price to free cash flow alone is down over 50% from its historical norm. So I really want you to ask yourself, what does it actually mean when a P/E ratio drops almost 65% from its historical average, landing at 26.56? Does that mean the underlying business is falling apart? Or does it mean this asset is just uniquely on sale right now? Because that is the billion-dollar question. When we shift our focus to enterprise value metrics, we see the exact same story of compression. The EV to EBITDA ratio is sitting at a very grounded 12.05. Just for some context, that is down over 40% from its 5-year average. Across all these metrics, the market is heavily pricing in a lot of pessimism. But is all that pessimism actually justified? Let's step away from the price tag for a minute and move to Section 3, tracking growth and returns. We really need to look under the hood and see how this company is compounding its earnings. The data here, it shows relentless compounding. Look at that earnings per share growth. This is not just a one-off fluke, folks. They are consistently hovering around 24 to almost 39% growth across multiple timeframes, whether you're looking at the trailing 12 months, 3 years, or 5 years. The earnings engine is absolutely running hot. And what you should really take away from this is the incredible operational leverage Merit Medical has achieved. While top-line revenue grew at a very steady 9.7% over the last 5 years, their net income absolutely exploded by over 100% annualized during that exact same period. They are exceptionally good at turning those top-line sales into hard bottom-line profit. Keep in mind, though, that MSI's historical stock returns are highly cyclical. This timeline shows us just how wild the ride can be. They swing from massive highs, like a 63% gain in 2017 and a 77% gain in 2020, to sharp pullbacks, like a 44% drop in 2019 and our current year down over 30%. So the business steadily grows, but the stock price, it's a total roller coaster. Which makes our next section incredibly critical. Section 4, margins and financial health. Let's see if the company actually has the financial armor to survive this current downward stock momentum. Because listen, before we can ever definitively declare a stock to be undervalued, we have to verify its survival. Is it drowning in debt? Is it struggling to find liquidity? If the answer is yes, well, then a cheap stock is just a value trap waiting to happen. Fortunately, the data here is incredibly reassuring. Check out this financial armor. With a current ratio over 5, a quick ratio of 3.46, and a very low debt-to-equity ratio of just 0.45, Merit Medical has highly robust liquidity. Their current assets easily dwarf their short-term liabilities. They are on very, very solid ground. And looking at their profitability slices, the health story just continues. They maintain a very strong gross margin of over 48%, and they're bringing 8.5% directly to the bottom line as net profit. And what's really great to see is that this net margin is actually up from its 3-year average. They're getting more profitable, not less. This highlights the management team's efficiency perfectly. Return on invested capital sits at 7.15%, and return on equity is at 8.57%. But the absolutely crucial point here is that both of these metrics are actively beating their historical 5-year trends. They are deploying capital more and more effectively as time goes on. And now, we arrive at Section 5, Fair Value and Margin, the final act. This is where we combine the price, the growth, and that financial health into one single concrete assessment of its true value. Let's quickly recap how we got here. By following these logical steps through the data, we've systematically proven that the business is fundamentally growing and financially sound, even while the stock price is falling. We checked the depressed multiples, we verified the earnings growth, and we confirmed the absolute safety of the balance sheet. Now it's time for step 4. Based on their discounted cash flow metrics from the source data, the numbers reveal a staggering fair value price of $247.03. Let that number sink in for just a second. When we put those two numbers side by side, the contrast is just wild. We are comparing the reality of the market today at $61.36 against the mathematical fair value of the company's cash flows at $247. The disconnect between what the market is paying today and what the business is mathematically worth is absolutely massive. And that massive disconnect translates directly to a 75.16% margin of safety. What this means is that, according to the cash flows, the stock is currently trading at a severe discount to its calculated intrinsic value. So I'm going to leave you with this provocative thought. When a company's underlying data shows exceptional financial health and compounding growth, but the market price screams disaster, leaving you with a 75% margin of safety, are you looking at a value trap? Or are you looking at a generational bargain? The numbers give us the clarity, but how you interpret the market's fear, well, that's entirely up to you.